Rajiv Batra, Head of Asia and Co-Head of Global Emerging Markets Equity Strategy at JPMorgan, joining us this morning. Mr. Batra, thanks so much for taking the time and pleasure speaking with you. The question we've asked a lot of people is what they thought of the tone and tenor more than anything else, because some of the announcements that were made, particularly with regard to capex and otherwise, were along expected lines. Perhaps that thunder was stolen by what was announced that people did not want. What do you think?
Thanks for having me today. So I believe devil always lies in detail, but this time around it's not devil, it's an angel. And here I'm talking about STT. Yesterday we saw the knee-jerk reaction from investors, and it also came along, we need to recognize, where meltdown was happening in commodity space, although it was shut on Sunday, but the meltdown was happened during Thursday, Friday, and happening now. And along with that, geopolitical uncertainty has been on the prowl. So STT hike, which nobody was anticipating. In fact, if I take step forward, based on my conversation, some of the people were anticipating some kind of a changes in LTCG. When it didn't came through, people reacted. But as I said, angels lies in the detail. And here, the things you look at, this is a third such hike in last 4 years. And historically, whenever the hike has happened, we have not seen any kind of an impact in our volumes per se. However, this time around, it will be interesting to see whether the volumes in futures will try to converge into volumes in options because of the lower taxes. Beyond that, if you look at the maths of STT, 3 basis point on a future, 2.5 basis point on option, cumulatively annual cost up for a hedge fund close to 60 basis point. Now taking into account the bid-ask spread, very competitive one, very small or narrower compared to what our exchanges offer, compared to any other emerging market. 60 basis point annual jump in cost over there is not a meaningful enough to stop people investing into India or trade into India. And adding to that, looking at the growth picture of volumes in India, HFTs, where all question marks are around, even for them, it's not a losing proposition per se. So as the dust settle, what we have seen in the previous April budget, February budget of 2023, then in October budget, and now I think market will go back to normalcy mode, looking at growth, looking at policies, rather than worrying too much about STT.
Rajiv, good morning. Neeraj here. So, sorry, just a follow-up there. So, what is the angel? You mentioned that people will get back to those things. You've spotted some positives out there, which is why you're calling that it's an angel in the detail?
Yes, I will say it's an angel in the detail, because it's important to recognize that in some of the other exchanges in emerging market, particularly in our neighborhood, the bid-ask spreads available are 1%, 1.5%, 80 basis point, where in case if STT hikes happen in that particular arena, it's become punitive for you. In case of India, if you look at the bid-ask spreads of the stock being offered by NSEs and other, sometime it is 1 paisa, sometime it is 5 paisa on the stock price of 1400, 1500. So that clearly shows that my hedge fund community are not that much worried per se of what the STT hikes have happened. And today's market reaction is showing you that yesterday was a knee-jerk reaction, and today the normal services resuming.
Rajiv, hi. I'm so glad you've used that phrase, angel is in the details, because I actually put out a piece yesterday exactly with this point, that people maybe got a little overwhelmed with the STT bit and did not go into what everything else was on offer in the budget. Having said that, is there a case for foreign investors to come back to India at all right now with the current budget behind us?
Very high chances, and likely chances, not just purely because of earning growth, but also because of what is happening now. I'm sure you are seeing what's ongoing in Asian markets today. With all the doubts appearing on AI spending, today most of the Asian markets are in sea of red, following up what has happened in the US tech space, or you can say the AI space last week, particularly last 3 to 4 days, where market has stopped reacting to good news about what capital you are raising or what capex you are going to do. If market goes all out against AI trade, then India will be like oasis in desert. It will not be just a pure safe haven. Here people will come out to safeguard their capital, to take that long, boring trade when they are creating short outside. Taking this view into account, because we knew at some point of time this year, the AI theme will get challenged, and hence we gone with the barbell approach. On one side, we were liking China and Korea, but on the other side, we kept our overweight on India. And I think beyond earning growth story, which is slowly, steadily coming back on India, if the whole AI theme start rolling over, India overweight or India equities will be back in the game.
Don't really know if that's happening or not. You have, of course, NVIDIA saying it's going to pull back on its OpenAI investments, and that is one clue. If investment does come back, foreign investment does come back to India, where is it going, Rajiv? Are valuations now seeming comforting enough?
So India valuation relative to emerging market was at around 110% premium. Today, that premium has declined to less than 45%. That's number one. Number two, India's valuation to S&P 500, like people used to say, India trade like S&P 500. Today, it is trading at a discount on a long-term average basis, where S&P is around 26p, India is close to around 20. But the most important indicator for my investor is PEG ratio, price earning to growth ratio. That's where last 6 quarters India has been in trouble, because India's PEG ratio has been in the range of around 4x to 5x. But last quarter and even in this ongoing quarter, we are gradually moving towards a double-digit growth handle. And if that being the story and PEG ratio comes below 2, yes, India valuations start looking attractive. On relative valuation term, it is coming back in conversation with the value investors. But when you take PEG ratios into account, you need 2 consecutive quarters of double-digit growth to look sustainable on a PEG ratio term.
Okay, I do want to ask you about that though, because the underlying earnings, we've spoken about the valuations, but what is your anticipation heading into the new year? The reason I ask is that you've not had announcements that would tell you this will dramatically shift corporate earnings one way or the other. So therefore, assuming that that has no bearing, more of the same, do you anticipate consumption will pick up? What are the levers that you anticipate will play out that will move the needle for corporate earnings in FY27?
So definitely, look, budget is, we should not see it only arena where big bang announcements are going to be made. Look at the last year example, be it the announcement on the GST, be it on the measure of reforms on the labor side, that were all done even outside the budget. Budget, you have to take into account, it's also like an accounting exercise where you will get the big picture over there rather than just for one fiscal year only. The good news on the one fiscal year, which is getting overshadowed by this STT hike, is nominal GDP growth forecast is being given at a double-digit handle. Remember, for this ongoing fiscal year, it's a stretch even to hit a 9 mark, and that shows up in your revenue growth and earning growth also. If double-digit nominal growth is making a comeback, then your revenue growth, which is also following your nominal growth, will also follow that particular mark. That keeps you in a safer terrain, like earnings will follow. Now, what will be the key driver for your earning growth or a nominal growth? Definitely, number one will be consumption. Look at the allocations toward the rural area. Under various scheme, and even I will say under different social scheme that being announced. Second, look at the growth in the state transfers. We have been seeing that one-off cash transfer handouts are already happening, and that may continue, which upcoming state elections too. So taking that factor into account, plus 8 pay commission is upon us. Consumption as a support measure will continue, but beyond that, look at the capex scheme of thing. Yeah, overall it seems like based on the revised estimate number is up 5 to 6%, but the detail shows defense you are supporting by 17% growth, defense capex, and the PLI in different area, electronic component, in construction, in auto space overall. So all in all, you are now trying to totally focus on domestic demand. You are focusing on domestic plus within the country localization effort. That will be your key factors of growth support, which means my sectors like financials, consumer discretionary, materials, even I will say hospitals and real estate will be the key drivers for earning growth this year. Maybe not as much in line what consensus is giving. 17 to 18%, the handle at which consensus is, but 12 to 13% for this fiscal year is very much on card.
Rajiv, you've energized the bulls on Dalal Street for sure with this conversation. Look forward to talking more, maybe in the next couple of months, to try and assess where the markets are and what your view is then. But thank you so much for joining in today.